Welcome everyone to today's Finance Unplugged Expert Talks interview series. Today we have a guest with us from Sweden, Jakob, who has a wide range of experience across credit risk and risk management functions. And today we will be going over his career journey from theoretical physics background to becoming a modeling expert and having a great career across banking and finance. So, Jakob, welcome to the session, and would really like to hear about you.
Thank you so much, and thank you so much for having me. Looking very much forward to the conversation. No, but to start off, just as you said, I sort of started off in physics. Already when I was in high school, I was sort of recruited into this physics organization where we sort of we worked on different sort of physics problem. One problem we, for example, worked with is that if you look in, for example, carbonized water and you look at the bubble rising, the bubble isn't actually rising straight. It's actually doing a little bit of a dance like this when it's going upward, which is because the bubble rising up, there is an empty space from either side. And if water flows in from either side, it creates an instability. But if you do it in a more a heavier liquid, like for example oil, you will see that the bubble rises exactly straight. And it's because when the liquid gets less and less viscous, you get this critical point where you can get this dance. So that was, for example, one where we sort of, you would have a lot of experimental people that would gradually change the liquid. And then me and some other people were in the more theoretical team that we would build sort of, models for this. And then you would have like large Excel spreadsheet with like data on the behaviors of these bubbles. And I would basically my job was often to sort of try to merge these worlds together. Okay, there's a theoretical model, there's experiments. Can the experiments explain the model? Is there something missing? What is sort of, do we need to adjust the model in some way? And it was, very fascinating. In my final sort of years within that organization, I was sort of the head of research and responsible for it. But after having been there for a number of years, I mean, that was very fun. We did a large transformation organization. I'm very much, a very classical nerd. I like to dig in the numbers. I like to do that. When you become manager, you have to start talking about, employer motivation and you have to, call and to get sponsor money and so on. And that was never really my thing. So right around there, one of the board members of this organization, he worked for one of the local banks in southern Sweden. And you might be familiar, there's this large international furniture company, IKEA. And IKEA also run here in the Nordics, they run a banking operation.
Okay.
Remember, he worked for this bank normally, and he knew that they were basically lacking people. And on the quantitative side, because in sort of most sort of banking sort of quants, they sit in the capital of Sweden, but this was down in southern Sweden. So he basically approached me and said, look, I think they're looking for people. Would you be interested? And I interviewed with the head of the modeling team, and he said, okay, like how much do you know about IFRS 9 models? And I said, yeah, I don't really know what the letters stand for, but like it's all numbers. Like let's see what we can do together. And basically signed on and a little bit threw myself in without really knowing what I was expecting. But it became really fascinating. So as I say, the first bank I worked for were this Econobank, this bank of the IKEA empire. If you shop at this furniture store, you can have buy now, pay later for furniture. Then this loan goes into this bank. You can have like a credit card that gives you special discount in the store that also sits in the bank. And they also ran a pretty sizable leasing arm. So if most companies, for example, a coffee machine, you might think, oh, this is the coffee machine of the company. Typically, the company will lease this coffee machine. Same thing with printers, same thing with the vehicles and so on. And the reason for this is that the company would like to pay it over time because the company's money is quite valuable. On the other hand, the company producing the coffee machine, they need money right away because they need to buy new material, they need to manufacture it. So then you have a financial partner in between that basically pay the coffee maker right away, but then can get the payments over time from whoever have it. And we had a lot of this business, leasing all sort of crazy objects like jumping mats, party tents, and so on. And for example, there I got a really, when you talk about sort of, in the credit risk analysis, it was really interesting there because that was, for example, my first glimpse of getting to understand what we call LGD, so loss given default. Because One part is, of course, figuring out, will your counterparty not pay you? But if you're in a leasing business, you have this leasing object. Okay, you really need to understand what is the resale value of this leasing object. Certain objects are very easy to sell back. Let's say vehicles and so on, they're very standardized market, and it's pretty easy to figure it out. But certain objects can be, for example, I've talked about these jumping mats. Okay, you might have questions. Okay, are they still safe? That could really influence if you're able to sell them again. And same thing could apply to a lot of other things. I also got to see this fact that you have what we often call wrong way risk. So imagine a company that is about to default. This might not be the company that really takes care good of their vehicles. So the vehicle might actually be in worse shape than you really would have thought just from sort of its sort of linear amortization curve or something like that, and the value might actually differ quite a lot. So in that sense, I mean, it was a really interesting to to get to dip your toes in that world and to starting to work and understanding how sort of credit risk work. So having been there after a while, I was there during, for example, COVID. And one of the challenges during COVID, as I think most of us who worked in this industry, was that suddenly, the historical behavior did not really work that well. And there was a lot of questions, okay, how are customers going to change? In particular, there was a fear from management that risks were really going to skyrocket. And the question was, okay, like how do we adopt our models? But of course, a problem is that if you build a classical, probability of default, you often have these classical scorecards. And what you typically do is you look at a 12-month performance window. Yeah, but that means that you have to wait 12 months until you recalibrate. And we were sitting in the midst of COVID, 12 months hadn't even passed. Management was not going to wait for 12 months until they took some action. So something had to be done right now. And my manager came to me and said, look, is there something you could do here? And my idea then was to move to survival analysis, because in survival analysis, you're not stuck to one size of the window. You can use smaller windows, you can use longer windows. And the idea is that you basically intuitively, like how many people are defaulting up to 3 months, 6 months, 9 months, and so on. If suddenly these numbers are higher than what you historically saw, then you should really adjust up the entire risk profile. And I was part there in building a system which sort of automatically adjusted, would read in all the data that come in, and it would look at the entire decay window and see, do we need to increase it or do we need to increase it or decrease it? And it adjusted it. And the really controversial conclusion we came up with was that, in fact, the risk was going down. And at first, this was very controversial, but it turned out that there was a good explanation. It turned out that because people weren't really out shopping and so on, because they were basically confined to their homes, that also meant that there was more money at the end of the month, and this money could then be used to pay their bills. And this led to that what we actually saw was that the default risk actually went down quite a lot during the COVID times. So it was a really fascinating journey to get to see that. Then I was also within this company, came also the problem of validation, because we had been getting questions on how should you validate your models. And since I had worked as a physicist and I had worked with, comparing, these theoretical models to the experimental data, my manager basically said, look, I mean, you have some experience in this. Could you do something with this? And I said, let me make it a try. And one of the things which we built, one of the big challenges in validation, especially if we talk, your classical, probability of the default, PD, exposure at default, EAD, loss given default, LGD, you have these three models, but you usually have different metrics how to evaluate each of them. So if you now sit as let's say you sit as senior management to say, where should we prioritize our resources? Should we fix these PD models? Should we fix the LGD model, the EAD model? You don't have a common sort of basis onto which how to compare them, which is a problem when you need to allocate limited resources. And what I built was then basically a sort of simplified calculation that allowed you to determine, because the PD has been historically wrong, how much is the balance sheet off, basically. So how much balance sheet effect, how much is sort of the aggregate ECL effect from just the PD? Then calculating the ECL effect from the EAD and the ECL effect from the LGD, because then you could make basically like a scoreboard, like who has the, sort of the most average error, who has the most average, or has the relative average error. And basically that led to us being able to sort of make a better priority list. having worked there for a while, I was then approached by one of Sweden's largest credit card companies, or also one of the major players in the Nordics within credit cards, because they were basically looking for exactly what I was doing. They needed someone to do IFRS 9 model validation. And it was a great challenge then to be able then to come to, I moved up to the capital of Sweden then to work for them, and really interesting to get to then work with, how do you really do validation? I think one of the main lessons I learned there was that I think too often we as validators focus on different metrics and different tests, and there's nothing wrong in metrics and tests. These are great tools, but that's not the first thing you should do. Like, the first thing you should do is that you should say, do I get a bad feeling about this model? Is there something about this model that's not really making sense? Is it something that looks off? Once I got a model where they had shown that, the more the customer would borrow, the lower the risk became. And that looked pretty weird. And I dug into it, and what I found was that you had basically two groups. You had people that had, for example, come off like debt restructuring and so on. So basically nobody wanted to lend them any money, so they had very little debt. But they were pretty risky, because if you would give them debt, they had a higher propensity to not pay on it. On the other hand, in another group, you had people that had mortgages, and mortgage owners, relatively speaking, are often quite responsible. It's often families, they're often quite well established. But of course, in terms of absolute amount of debt, I mean, they have very much debt. So basically, the problem was that if you just took the debt variable and you didn't look at what type of debt or the nature of the debt or the other reasoning, you basically came to the wrong conclusion. Because if you then say, no, more debt means lower risk, it means that if you have like a customer who have like consumer debt, then you say, oh, but just take on another million of debt, and then you will be a very safe customer. No, that's not how it's going to work. And it's very hard to find this by just raw testing, because testing is not really going to tell you these sort of things. This is where the business understanding comes in, and why it's so important when you work in validation that you also interest yourself for the business model and how it operates. So this was, to me, a quite eye-opening experience when you got to see that, look, this is something that a test can totally miss, but it's something that you can find if you literally try to understand how the model itself operates. And I mean, the solution here was really to say, no, it's not the debt we want. What we want is home ownership. So if you're a homeowner, you are probably pretty safe to borrow to. Okay, that's the variable we want. And that explained almost as much, but it did not have this weird defect that you could just go on a lending spree and or borrow everywhere, and you would be perceived as safer. So I worked for and what I also saw a lot when I worked for in validation venture card was that at the end of the day, if you talk metrics and things like this, if you have good modelers, they will have already covered most of their bases there. The Gini will be good, the accuracy will be good, and so on. That's not typically where the problems are. The problem might be instead something that is easy to miss, like, is the definition of default set up the right way? Is the numbers themselves calculated the right way? Because that's not, if you do that the wrong way, you're not going to get any signal that you're doing the wrong thing. Let's say that you accidentally define default the wrong way. I mean, then, all your tests is also going to be on the wrong default definition. And it means that it's very hard then to sort of see through this problem. And I think that was one of the sort of main thing that I really got to learn, like this sort of challenge when you might have something, even before you even start analysis, you might then be wrong off there. So again, I thought that was really interesting, and it really got me into this. They realized it's important that you sort of look into the standard, you try to understand what you're really supposed to do, because there are many places where you could say either off. I think a good example is that if a customer comes in and they want to renegotiate their loan, how the current standard in IFRS 9 said is that if it's a large renegotiation, then you should treat it as a new loan, and you should actually derecognize and recognize a new loan. If it's a small loan change, what you should really do is you should keep the loan on your book, but you should calculate the present value effect of changing these cash flows, and you should run that present value effect through your P&L. Now, that's in no way obvious that that's the way you are supposed to do it. And in fact, there's even talk now about changing the rules. And this is why I think one of the mistakes is that if too many quants focus very much just on sort of, you can focus on very advanced quant models, but at the end of the day, you need to start from the very basics. You need to start from the business side, but you also need to start from understanding what are the rules that we are working within and how are these rules being set up and how do they work? Because you can get into positions where you say, oh, I could do this way or I could do this way. And mathematically, it's sort of, it's either good, but it could be a clear preference from the models or a clear preference from the regulation that you're supposed to do things in a certain way. And then finally, after having been with Entercard, this credit card company for a while, I was then recruited to work for Handelsbanken. And Handelsbanken is a little bit, let me mention them shortly. I mean, as I said, everything I say here is, of course, I say as a private individual. I should be really clear. But I still want to throw in that I think one of the really cool thing about them is they're very sort of old school bank, very sort of, branch heavy. They have more branches than any other bank here in Sweden. It's sort of, old school where you have like your own, relationship manager that take care of you and so on. And I think the really cool thing for me and where I really grew in that sort of environment was it meant that there was a lot of people that had an excellent qualitative understanding of credit risk. Like you could call people up and ask, what happens if you foreclose on a mortgage? And they can explain the process because they've been through the process. You can easily find people that have been here for 20 years, they've seen everything, and they have an excellent intuitive understanding. And my job as a quant is to try to take that understanding, turn it into math, do something with it, and then come back with something that takes a lot of their insights, but then sort of streamline it and makes it even more refined using numbers. And I think too often we as quants again forget that. Like you get some data set, you throw yourself in, and then you do some very, very advanced analysis. I will tell a little bit of an anecdote. A friend of mine who worked when I worked for a previous company, he originally comes from India, and he worked to the Indian version of Uber. And he was in data analysis. And what he did was that they were looking at, they were trying to find, statistically, when are the delays of the cabs. So they were doing all sort of very advanced analysis and clustering and so on. And they found certain segments of time, and they were very, very, very impressed. And one day he's standing outside the building, and there's some of the drivers, and they look a little bit suspicious of him. And they say, oh, what do you do? And he said, oh, I also work for the company. I'm a data scientist here. And he talks about what he have come up with. And the drivers just shrugged and said, yeah, I mean, what you describe is rush hour. I mean, if you take one cab drive with us, you would have immediately found this out. And I really love that story because it really tells you that you can learn so much if your quantitative powers are so much more powerful if you combine them with the qualitative context that a lot of people in the business can provide you with. Whenever, for example, I am talking about, this IFRS 9 credit risk framework, one of my first advice to people is go out into your business, understand your credit process. Sit with your collection team, listen into a few calls, like what's happening. Try to understand how do you originate credit, how do you take care of credit, how do you try to deal with credit when they become distressed, and understand these parts and make sure that your model mimic it. And I mean, if the business say, oh, we really care about this variable is really important. Okay, if that variable is not in the model, either you have missed something, or it might be also that the branch is off. But either way, it gives you great insight on where should you start digging. And I think this is really something I got to learn working within sort of, this sort of branch-heavy operation. And similar, also my sort of time here, I came more or less right after the Silicon Valley Bank failure. And that was also very interesting because in no way, European banks have relatively speaking, much smaller of this interest rate risk exposure than if you compare to US banks. But still, Silicon Valley Bank used a model design, which we call replicator portfolio, which have some complications in it. It assumes that customer behaviors remain very static. No matter what the interest rate level is, customers behave the same way. No matter if you have negative rates, you assume that you're able to pass negative rates onto the customer. You assume that customers, no matter how long they've been with you, behave the same way. I mean, in reality, we know that none of this is true. So we know that customers actually behave very, very differently in a low rate environment, in a high rate environment. Because in a high rate environment, there's a lot of alternative investments you can make. There's a lot of people that are competing for deposits because the deposits are really valuable. In a for example, negative rate environment like we had for almost a decade in Europe, there isn't really, deposits aren't really worth that much in the short term. They might be in the long term, but in the short term, they're not really so valuable. So not so many people go after them. So you more have, the customers might be able to stay with you for a long time. But the problem is if you don't build in this dynamic into the model, and you just train and you say, no, everything should be static. I mean, if you now train the model on data that comes from this low rate period, then the model is going to assume that also in a high rate period, it should have this low rate behavior, because that's what you trained it. And I think that was a really important realization, that at the end of the day, I mean, the model operates within a simplified universe which you have built. So if you don't build in some coupling to the interest rate environment, the model is not going to see it. And this was one important reason why Silicon Valley Bank got in trouble. So they trained basically their model on very static data that they had seen, which was in this low rate environment, which was not really representative of the new volumes that came in during COVID, and also on the fact that the interest rate environment went up quite a lot. And it led basically Silicon Valley Bank to sort of underestimating the risks in that customer would leave them. They tied the money into very long positions, and they even took even more risk than that. So even if they didn't even have, even in this very optimistic model, they didn't even run a balanced position. And of course, they took excessive interest rate risk, and that ended up in them getting destroyed. And there was basically a push then, post sort of Silicon Valley Bank, there was a push to say, can you make these models better? Because this is a pretty sort of, there are some flaws in this design. And we worked then for a number of years in building a much better design where you much more try to think, okay, how is the bank thinking? How is the bank actually pricing these instruments? How is the customer responding to the market pricing or to the market rate and to the pricing that we give them? So you much more think about, there are two different players here. It's the bank and the bank's decision, and it's the customer and the customer's decision, and how are they operating over time. So I also got to then be part of building and working on interest rate risk, apart from sort of credit risk that I've done previously. It was also a really fantastic journey to sort of, we started from regulation, getting the data, building the models, getting sort of every system to work properly, all the way to even going up to the regulators and getting to present to like the supervisors on this, and really be, I was very proud to be us as a team. We were a little bit of trailblazing in that we were really the first one to get approval here in Sweden for this model, which was a really fantastic experience, because that also meant that, you had to be the first guy through the wall. It meant that you had to take a lot of these conversations with the supervisors. Though I think the good news is that in a small country like ours, it was easier to have this discussion with the supervisor. It was easier for us to get meeting with them and show our work, not to sort of influence them, but I think that gave them a lot of understanding of the risks that we were seeing. Because sometimes there is this misunderstanding that you say, the safest way to treat non-maturing deposits is that you place them in zero duration. So you place them at the central bank. That is really safe. You're not going to take any loss there. Yeah, it's not so safe if you think about it, because if you have let's say that you have deposits which have zero rate, like a classical transaction deposits, and you place it at a bank which and you place it at the central bank. Now, you earn some money from the central bank, and that's more than you have here. But now what happens if the central bank is lowering its rate? You cannot lower the rate here below zero. So basically now your NII is getting squeezed. And you might say, but as long as the central bank doesn't go to negative rate, which they actually can, but as long as they don't go to negative rate, you still have a positive NII. Sure, you have a positive NII, but it is incredibly costly to run a deposit business. I think people often underestimate that. I mean, to run a deposit business, you need to have your branches, you need to have support staff, you need to have people that answer the phones 24/7, because you cannot really say to people, wait until tomorrow until you withdraw your money. That's not going to work. You need to have a lot of IT and technology, and it needs to basically be able to run 24/7, and that puts a lot of strain. I mean, you have to build things very, very differently if it never is allowed to break, compared to, if you just test something on your own in your home. So it means that you have a lot of fixed cost in this business model, and if your margin now is getting squeezed, there's really no simple way for you to sort of gain more income. Then basically you now have an exposure to negative rates. So you have an exposure to lowering in rates. So just basically placing the money with the central bank, that gives you downward risk exposure, but placing it out into long fixed rate assets, that gives you positive rate exposure. So the question is then, okay, how do you find a good in-between? You need to find an appropriate in-between size, and this is where the modeling comes in. And it's more or less an impossible problem to solve without dealing with a good model. And why it's so essential. So it was really fun that, I got to be in, the credit risk territory, model risk territory, interest rate risk territory. And what you really see and what unites all of these is, as I still say, it's the understanding of the business, the understanding of the regulation, and the ability to then make something out of it by starting very simple. Often you start from, I think a mistake sometimes people do is they try to build everything at once. But we built, for example, this interest rate risk system. Often, in the beginning, we would build, we would take one easy toy example and we would do it like in an Excel spreadsheet and just be talking about, okay, here is a very simple example. In this case, how will the deposit behave? In this case, what's going to happen here? So you start very, very simple, and then you gradually build yourself more and more and more advanced. And that means that what I think people miss then is, but then you have a lot of wasted work here in between. No, but what you build is your own competence. What it means is that when you get to this final model stage, you will have a lot of intuition around how the model should behave and not behave. So you will be able to check at many places, like, have I done the right thing? Have I coded it the right way? Because it's very easy to make coding errors and that mess everything up, and you need to have a very close intuition on, like, okay, what are reasonable numbers? If I put in this, should I get approximately that? And that's very much like a journey that you gradually build upwards. So that basically took me from, I started in physics, got into this sort of worked within more sort of leasing, unsecured business, worked for in credit card business, then finally working in this sort of major, very traditional sort of mortgage, commercial real estate, branch heavy banking operation.
Okay, thank you so much for for going into the depths of your career journey, because one of the main things over here is to understand what are the implications of your work. Wherever you are working, whether it be in a bank or in a credit card company, and the interaction between the qualitative and the quantitative aspects is something that you thought was a major turning point in your understanding of how the credit risk and risk management functions. So one thing is regulation. So you said that when you started, you said IFRS 9 are just some letters, right? There might be some viewers for whom IFRS 9 just some letters, right? And these viewers might be coming from FRM background, maybe from CFA background, maybe from commerce background, but no certification, and looking to make a career in banking and finance. So, as you started your career and you found it really enriching and really rewarding for you, right? So I feel like you will be able to provide some input for people who are looking to pursue a career in credit risk management, in model validation, development. So validation is one aspect, development is another aspect. What are the kind of skills or interests that you need to have if you want to be successful in validation versus development?
Very valuable, valuable question. I would say my absolute first advice that I always give is what they call take the scenic route. So what I meant by that is that, let's say that you work in a bank and you are given a task. Okay, like you can absolutely do it the very quick way, but whenever you have the opportunity, try to dig a little bit around, try to take that route that teach you something around why do we do what we do. And sure, there's a business to run. You cannot just stop everything, but take the opportunity to understand the landscape around, because it's often much easier to learn in a concrete context. So I mean, if I can absolutely take a book and I can look up like the LCR, but let's say I sit with the actual LCR of the bank and I say, wait, why is that number larger than that number? Look, now you really start to really see the learning in context, and it's much easier. Or a good example, a colleague of mine who works with LCR, when he was new, what he did was whenever he would do a number, he would, for example, sometimes he would take some of the numbers and he would look it up with some of our competitor banks. And he would say, oh, why are these higher and why are these lower? And I think that was a great way to get an understanding in context. So often my advice is whatever you do, say, okay, can I, on a little bit of my spare time, can I dig around it? Can I understand what they do? Because not only will that mean that you become better at your job with all the, nice thing that entails, but it also means that you gradually build a wider understanding around it. I think, for example, if you, let's say that you work, again, let me stick with the LCR example. If you work on LCR and NSFR, what you should really be thinking about is, why do they even exist? So a good place to start is to look what happened during the financial crisis, because they came during the financial crisis. And for example, one can look at the story of, for example, Bear Stearns, that really had this problem with that they have very, very short-term funding, and they basically got into trouble where all their fund, like a significant proportion of the funding was like 1 day funding, and they constantly have to sort of try to roll that over. And this was one of the reasons why we created rules then, that banks should not have too much sort of short-term funding. But it becomes much more alive once you know the stories, like what sort of banks had trouble with this. So this is really what they mean by the scenic route. Like, you start where you are and say, okay, how can I be slightly better at what I do around by learning the context, understanding what is going on, trying to also be better at sort of also explaining it, because I think that's also a really important technique, that you are able to put what you do in context, you're able to sort of elevate the pitch it, as I often say. I mean, what you should always be able to do is that whatever you work on, you should be able to have like a 30-second version where you say, like, someone says, what are you working on? And you should be able to explain it, not only say, I'm doing this, but also place it in the wider context of how the bank operates. Within our bank, one of the things we are very proud of is that we say there are only 2 jobs within the bank. Either you make business or you support business. And if you support the business, you should understand what business you are supporting. You should be able to draw a line from what you do all the way over to where the business is being made, and understand that. And I also think, there is the really important advice I often give as well. Quarterly reports, I think, is highly underestimated. I mean, listening to quarterly reports and trying, when you have these analysis calls, and trying to understand, I mean, start from, the institution you are with, and start from the peer institutions, and understand, what are they talking about? How are they talking about, for example, the topics you work with? How can you connect in what you do with it? You gradually start building your universe. So when I started, I started on credit risk. That's where I was starting learning. But then when I then came to interest rate risk, okay, then now I suddenly had sort of, 2 areas that I could sort of try to connect together and so on. But you basically start from where you are, because when you work with it, you learn from it, and then you basically learn the wider context around it. I think that's often is a very good place to sort of get going. And sort of no matter where you sit within a bank, there's always, that you can start bridging out and start learning from where you are. And that also gives you a better understanding. Is this what you want to keep working with? Or is there something else sort of slightly outside that where you would want to proceed in that direction?
Understood. So, one of the questions that I really have for you over here is, how do you think one should be approaching learning about the theory? So, if you're working on a model, it's very important to understand the theoretical concepts also, right? And then you need to know certain tools like Python, Excel, so on and so forth. And, there are people who often struggle to kind of relate the theory to the practical applications, right? So for someone just starting out, like, what is your guidance in how someone should be approaching a problem statement that is at hand, so that they can make the most out of it, give give some analysis, not just from a qualitative aspect, but also quantitative, like, errors.
Exactly. Let me give you a very concrete example, because I think that's a little bit, again, my thesis here is that you always start from the concrete. So in the theory of ordinary differential equation, you learned that in order for there to be a unique, or for you to be able to guarantee a unique solution to the ordinary differential equation, you need it to be Lipschitz continuous, which is basically saying, how the continuity should look like. Okay, that's a very abstract thing. So one of the best things then to do is to say, look, if I don't have that property, and for example, a square root function, has this very, very sharp bend. So it is continuous, but it is basically the slope becomes sort of infinite, and that is sort of not Lipschitz continuous. So what happens then? Well, there is a very simple example, which is that you have like a barrel, and you let the water flow out of the barrel. Now, how quickly the water flows out is going to depend on the square root of the height of the barrel. So it is exactly this type of equation I was talking about. And when you then do it with the math, what you can show is that if you just solve the equation, you will actually get a parabola as a solution. And so the first part of the parabola is very reasonable. The water flows out, but then it looks like the water starts flowing back in again into the system. That doesn't make sense. No, because there's not a unique solution, because the parabola could go down here and then become a flat line. That's your real solution. But just doing it sort of brute force math will give you the wrong solution. And again, my point is that if you see like a theorem or something for theory, search up like a simple example and then work out the example, because this property, for example, this Lipschitz continuous property, becomes so much more alive when you see like, why is there an issue here? Why could you get into trouble not having the property? And I often say, if you, for example, want to learn a mathematical theorem, you should always find an example where if you violate some of the properties that is required for the theorem, why does it fail? I often think, the failure is in that sense often more interesting, because it teaches you a lot of what the problems could be in the theory. I mean, another good example is that, let's say that you want to do a Cholesky transformation. Why will Cholesky transformation only work on a positive definite matrix? Okay, you then quickly see that, okay, if I try to do it, let's say, do then a 2x2 example, and then have it not be positive definite, and then you test the math, and you say, no, wait, I get like a negative number that I need to take the square root of. Okay, that's not going to work. Okay, now it's much more clear what you're doing and why you're working with it. So it's often to take, I often say when I try to learn something, I try to take what is the absolute simplest example that will illustrate the problem, and then I use that. And that's often useful also for your manager, because your manager will often be a quite impatient person, not because they don't want to learn. I mean, I've had great managers, but because they have many things on their plate. So they need the condensed version. This is often why I construct examples. So often my manager might come and say, oh, why is it behaving this way? And me trying to show in the actual system with everything is going on might be really hard. But if I come and say, look, it's basically because of this problem, for example, with this negative element. Here, I have made a very simple example. Let me just show you. That often gives much more insight than trying to explain everything in the very complex system. In physics, we call this toy modeling. And it's a very apt word. Like, the purpose is not that you say this is a model of the world. You say this is a toy model. It's a little toy. It's something we play with, but it gives us an understanding of the greater picture. And I often think that's a very useful also when you're learning. Like, you start from the simplest example, the absolute simplest version of what you do, and you play with that. And you get familiar with that. And once you have built that skill, it's much easier to progress to the next level. And there you mentioned, I'm very happy you mentioned, so programming, Python, R, these sort of programming languages. There is really where I think programming also comes in, because you can do a lot. Like, you can absolutely do a lot with paper and pen. And I'm still very old school in that I'm a very much fan of, doing math with paper and pen and so on. But you can also learn a lot from just putting up some, simple script in Python and trying to test it out. I mean, just you can do like a simple Monte Carlo simulation, or you may basically experiment a little bit in the computer, and it also teaches you a lot what is going on. And similar, back when I was at university, when I studied numerical linear algebra, our professor then told us something that really stuck with me. He said that if you have something that fails in a mathematical sense, often much earlier it fails in a practical sense. Take the example if you want to invert a matrix. So what is the property required? Well, the determinant cannot be 0. Okay, so you say if the determinant is any non-zero number, you can invert it. Sure, but imagine the determinant start to become very, very, very small, then practically you're not going to be able to invert it. So often it's also very interesting to understand the theoretical properties, because when you practically get close to the theoretical problem, that's often where you then run into trouble. So I think, again, that is a good illustration of sort of the challenges that, and to understand the circumstances better. That, sort of you understand like why things can go wrong, because that also means that's also become very practical when you build things. If you get out some weird error message, it often helps to understand when things can break down, because you experimented with it in a simple case. And in a simple case, it's also much easier to exaggerate. Take things to infinity, take things to 0, and you play around with it, and you feel, okay, wait, I understand why it's going on. Okay, when you understand the pieces, it's much easier to put them together into a whole story.
Understood. So, regarding this, just a question that would be, really interesting to address, I believe, is key. What does a successful credit risk analyst at your organization look like? Someone who has just started out. What kind of skills? What kind of communication etiquettes? And what's your ideal new hire for credit risk analytics?
Absolutely. I mean, especially if we look at sort of quant credit risk side, I would say first and most, there's sort of 5 things we always look after. I mean, once my manager simplified and said he's looking for happy nerds, but I think you can actually build it out. I was asking him when he was recruiting, I said, what are you looking for? And he said, I want a happy nerd. But if you expand it slightly more, I would say, you start from, the mathematics and, the quant sort of the very traditional sort of, quant skills. That I think is no surprise that you of course need that, and you need an understanding of that. You then go on to sort of, if you talk about, sort of the programming side, as we talked about, the programming makes things scalable. You can solve, things with paper and pencil, but it is the programming language that then turns it scalable. But it is in that order, which I think is important. What I think is a common mistake is that people start in the programming, and then it's easy to get stuck there, and then you operate with objects you aren't really understanding. Start from the mathematics side. Start with small examples, paper and pencil, and then you say, I use the computer as an elongated arm. It is the computer now that is able to. I could in theory, and I often say, a good rule is whatever you do on the computer, you should be able to do by hand with paper and pencil if you just had enough time. If the computer to a too large degree, you all sometimes have to make a little bit of a stretch here, but if to a too large degree you are calling an anonymous routine on the computer that you have really no idea what this is doing, then it's dangerous, because you also don't know if it's doing the right thing or doing the wrong thing. And when you work with this, you should always, if when you use routines on the computer, you should understand in what circumstances can they fail, and how would I know if they have failed. But you start from the math, you make the programming to your elongated arm. Okay, now you have a fair set of skills that you really could apply in many settings. But now we move into the area of credit risk. What do you need there? As I talked about, you need to understand the business of credit. Credit is a very, very special business compared to, for example, if you talk, an equity business. In equity, the upside is massive, and the downside is that you lose what you have invested. But since the upside can be so massive, you can basically, bet on 10 places, and then one of them succeed, and that pays for all the other losses. But in credit, you cannot do that, because in credit, your upside is fixed. You're only paid basically the interest that you are owed. So if I lend to 10 people and 9 of them fail and 1 of them pays, that's going to be terrible business. It's also going to be that my upside is capped, because if things go better than expected, I'm not getting paid more. And that is part of understanding what risks are in a credit product. A credit product have this sort of, sure, you are first in line to be paid, but you're also not really paid more than what you're owed, meaning that, you cannot really make up for losers with some winners. I mean, of course, things got to become blurred when you're parking really high credit, high interest products. In particular, when you start to work in, for example, buying distressed loans, they're almost a little bit of a hybrid here, because in a distressed loans, you might buy the loan, especially out in Europe, you might buy a distressed loan for like 10% of nominal amount. If you get them to pay, okay, now there's suddenly like a huge upside. So they're almost a little bit in between. But understanding the credit business, and you don't necessarily need to come with all of that understanding, but you need to come with a desire to learn. I think too many quants, if I'm a little bit, mean to my own people here, are a little bit stuck up. They feel, I went to a very nice, university education. I'm this very smart man. These, people in operations, they are beneath. That's the whole wrong way of approaching it. You are a specialist, and they are specialists in another area, and you need to learn from them, because a lot of these people that have, they've been sitting by their phones, they answer calls, they talk to customers, they understand a lot of how the business works that you who have not worked that do not. And you need to spend a lot of time with these with the operations people, talk to them, try to understand what they understand, because any insight you get from them is something you can then deploy with your special set of skills. So, I mean, when I, for example, started here in this very branch-heavy business, I got the honor of being out and visiting, some of the branches, sitting down with people, talking to the people that, for example, work with, for example, the collection side, or working with distressed loans. Okay, that's if you work in credit, understanding the distressed loan process is the absolute most important part of the business, because if there's no distressed loan workout, I mean, if you get paid on every customer, you have no credit risk. So understanding what really happens once a loan goes distressed is essential for you to then mimic that correctly in the model. And similarly, understanding how you transition from a good loan to a distressed loan. And then finally, I would add in understanding the regulatory environment. And I think it's important to understand it the right way. Like we should not be managing risks because the regulator tells us to manage risks. We are not sheeps that, okay, regulator tell us to measure X, so we measure X. And if X was the wrong thing to measure, okay, then it's the regulator's fault. I mean, that's not what you are paid for as a risk manager. You are paid to try to understand the risks of your firm. But the nice thing with regulation is that fundamentally regulation is often built on consecutive, there have been, for example, different bank failures and so on, and the regulators try then to develop things. So understanding how the regulation have been set up, understanding the language the regulation provides you with, that really provides you a frame to work in, and it provides you a language to be working in. It teaches you the language, of liquidity and solidity, and credit and interest and so on, and you have sort of a language to talk about, and it also mimics sort of often how the risk management is set up. But often I think the good thing that you should do when you get the set of regulation is that you should say, what is the real risk here? How would I, if I was, and now that I know what the regulator know, what if the regulation did not exist? How would I then manage the risk? I think, a little bit outside of my own field, but if you take, for example, anti-money laundering, I think is an excellent example. We don't manage or deal with anti-money laundering because the regulator tells us. We deal with anti-money laundering because these are really genuinely, scary people. And these are people that, can really mess up your organization if you get in these sort of, money launderers. And what the regulators really tell you is, guys, like, look out for these quite dangerous people. And you understanding that, and you understanding why it's dangerous, and you understanding what signs are of danger, that's useful to the organization, no matter if there's regulation or not. So the first step is always to deal with, what is the part of the regulation where you're like, okay, look, this is something we really need to deal with. Then you don't necessarily need to agree with how the regulation has been set up. Regulators have a certain perspective, and they also often need to set up regulation that works for every business. And, since businesses are different and banks have different business models, sometimes one regulation works better for another bank than the other. And that's a little bit part of life. But understanding that is also important when you go out into the business. Because if you come out into the business and you say, look, here's a regulation we need to follow, at best, it might be like a tick box exercise where people just, tick the boxes. But if you come out to the business and say, look, guys, like, we're going to make some great business together, but we need to manage our downside. and we need to make sure that we can run this apparatus successfully. Here are some of the things we can do in order to make sure that we keep running the thing. I will give an example that I often have when we have like new employees on our floor, and just to give a perspective on the risk level that you can really sustain as a bank. So if you look at our price to earning, it's around 12. And we have around, we give around 50% as a dividend ratio. Now, if you put those two numbers together, it means that if someone today buys our stock, just for them to buy dividend be net zero on our stock. So let's say they hold forever, but let's just say when are they have they been paid back from the investments? That is 24 years down the line. So we actually have a fiduciary responsibility to be able to run the machinery so that, just running it for the coming, quarter decade, that's only going to pay people back. So you have a responsibility to run the business in such a way that we can just keep running the business. And that should really tells you something at what type of risk level you can operate at. And I think that's really the discussion you should have in the business. You say, look, there is regulation here, and it's all about us having, a risk level that does not mean us taking undue risks that could long-term risk the successfulness of the business. And make sure that, people understand that, you might, take huge amount of risks in the short term, and that might be great, but it puts the institution at risk, because if everyone does this, sooner or later, someone is going to mess up, or something is going to mess up, and it could kill the business. And I think that's often, that perspective that, we are here in the long term, we are here to get that function long term, is something that you always should have in the back of your mind when you work in sort of, on the modeling side, and when you work as a credit risk analysis.
Understood. That's great. That's great. This is really useful, what you shared. And, a follow-up question here, which I feel is really relevant. So, you had a great opportunity to, work as a quant in credit risk. Now, what we have seen, a general perception when newcomers are talking about quant, they think it's trading. Quant finance is derivatives, maybe trading. But, I think it's important to understand that quant finance is all risk as well. There is quant finance in credit risk also, in treasury also, in market risk also. And like you said, you heavily work in quant, right?
There's nothing wrong in the trading side. I have never worked in trading side myself, but as what I've heard, it's absolutely fascinating. But I think one of the things to think about is that the banking book is actually often as or even more challenging. A banking book is a very, very illiquid trading book if you think about it. It's a trading book where you basically can never exit your positions in a good way. There is often quite limited way, especially on the credit side, it's quite limited way of hedging. So you really need to think about what you have as your exposure. You really need to think about the long term. You really need to think about basically how the valuations work in a way that, at the end of the day, if you sit on the trading book, you much more have a market as a sort of, counterparty where what is the valuation at? While in the banking book, it's much more up to you to understand yourself what is the valuation and how does these products work. And I also think one of the things that makes the banking book really fascinating is that you can focus much more on fundamental analytics. So if you again make a comparison to the trading book, a very simple example that you can make is that you can take a typical liquid stock and you look at, the daily returns, and you plot out like an autocorrelation function on these daily returns. And what you will see in most cases is that you will see essentially nothing. And that's pretty weird. Should not the stock have, some relations, and, you look at the actual performance of the company? No, because the thing is, there's so much people sitting in trading that the moment some sort of correlation shows up, someone is there to trade it away. But in the banking book, because you're not at all trading in an open market that way, you can much more be thinking about how are the customers behaving, how are fundamental factors working. So in that sense, I think it's quite fun to work in the banking book, because the banking book you can focus much more on understanding the business model rather than it just being a numbers game. And it really teaches you much more on, look, what type of customers do we have? How sensitive are they to, for example, if the unemployment rate change? You can be much more sort of thinking about the fundamentals in a way you cannot, or at least it's much more restrictive to do in the trading book, where it's basically, someone else have probably already traded on the pattern or the anomaly that is being discussed.
Understood. And a follow-up question again on this is, to be really successful, how important do you think, like, credentials like FRM, CFA, in your opinion, are in today's day and age? Like in terms of necessity or a catalyst, anything you want to share?
I mean, I would say, I've not taken FRM myself, but I have colleagues who have taken it. I've heard, great things about it. So I will in no way disparage it. And I think if the timing is right, that's absolutely, I mean, it's a place where you will get to see a lot of different things from what I've seen in the material, which is really valuable. My strategy is typically that, the best learning, as I said, is this starting from where you are. So as I talked about before, you start, if you manage to be lucky to get somewhere into banking, okay, start from where you are and master that, and then gradually expand yourself outwards. That is often a great way to sort of basically sort of build up your expertise, because you learn so much from really working with something. And it also provides, if you're asking yourself, okay, how will you be able to provide sort of a unique edge? Okay, the unique edge often comes from because you have worked with it, because 1,000 people can sit, with a book and read something. But if you have been in the trenches and really worked with something, and you have seen why it could go wrong, you've seen what could be the issue, so you have built practical experience, and you combine that with having around it and on your, a little bit on your spare time, you study up a little bit on the theory, you will have a very holistic understanding of it. And it also means that in your normal work, you can say, oh, yes, I know why this regulation existed. It was created because of that. That's also a good way to, show the foot forward, to get, the people around you to notice you, to become that person that, that people ask for things. Gradually, that builds your place within an institution. It also means that should you then want to switch within an institution, then people know, okay, this is a person that, takes the thing seriously. They build around it. So I often say, when you work, like what you should be doing is, say, let's master the work that you do, and then master what is around it. And that means that it's often much easier then to sort of gradually build your career outward. So for example, when I started in credit risk, I started learning with the sort of, how a PD model work. I then got to learn more like what is general IFRS 9. That was even more upward. Then, for example, there once came some people from the control function, and they had some questions like, which instruments are we having in different classification categories? And this is one of the things you have in IFRS 9, that you have like either you have it in amortized cost, you have a fair value to OCI, or fair value P&L. I had never heard about that. And I said, great, that's a great learning opportunity right here. They've come asked me this. Let me read up a little bit. What is this? And see how it works with what we are doing. And always be a little bit this, I often say this expression, whatever the road takes you, like, embrace it a little bit. Things will come up. Like suddenly someone will ask about something. And, there was a few months ago, for example, there was a discussion on AT1 bonds. How should you be, classifying them? Are they equity? Are they liability? They're great. This is a great. I've not thought about this too much. It's a great opportunity. Let me read up. Let me try to find a little bit material. Let me see what the ISAB, the International Accounting Standards Board, have written. And you get these episodes, and gradually, if you do it over time, you build a lot of really practical experience. Because not only in, for example, this bond example, can I say, oh, like I read about this, but I can say, oh, I was there when we were discussing this, and that was how this very specific example would work. Because combining a very specific concrete example with a general theory becomes very powerful, because it's easy to remember it, because it has this concrete aspect, but it's also then that you can apply the theory on it. And what we have seen, for example, when people, interviews and other places, what people often look for, the interviewers, is that you can show, like, here are some concrete episodes where I could, get into this position, apply this theory, and learn it. So I often say, whenever, if you have the foot in with a bank, start from where you are, gradually expand yourself from there. If you're not already with a bank, I think a good place to target is to say, okay, but look, can I start with like one of the areas, and can I find, some concrete data, for example? Kaggle is a great place to, get the data from, and you learn around it. And you say, like, the goal is not just to speed run it. The goal is not to because you're not, in this case, then you're not competing here. The goal is to say, okay, like, let me then look at the data I have. Maybe I look up some reference on, well, how can you deal in this case? And you try to build a little bit of a storytelling around, because that means that if someone then asks you, you don't just say, oh, I built a logistic regression model. You can say, oh, I looked into these variables and there is a good history that these variables are significant, or there are these and these researchers that did that. Look, there's a whole story around it. And it means that you get much more out of it than just, the exact data itself. And that's typically what we're really looking for. We're looking for people that want to understand the story around and be able to maneuver in that, not just, press a number of buttons on the computer.
Understood. So let's say I work at your bank and I work in operations. Maybe I have seen loan data set, but never really worked with models, right? And now I feel that, risk is a really a rewarding field to work in. And I've already spent 5 to 10 years in operations or underwriting. What would be your advice to me?
So what I would say is, like, start out a little bit yourself. I mean, there's a ton of sort of, free resources on, on risk modeling. Start a little bit trying it out. Like, is this something that looks interesting? Is there a little bit of data, like that you already are working with? Like, for example, if you have loan applications, okay, can you pull out some loan application data and you experiment a little bit with it, and you've come up with something interesting? I had a colleague of mine, for example, what he did was that he looked at when people get married, and one of them are with our bank and the other one is not with our bank. What is the probability that both of them will have our bank as their main bank? I mean, that's a very, in essence, not a super complex problem, but he learned a lot about the data, how do you connect things, and it was a really interesting analysis, and it got lifted up quite high in our bank because people got really interested, because it shows, how much sort of, when people really compare us against something else, how well do we stack up, which is a very interesting question. So often, start really small. Start with this, okay, what do I have? Where I sit, do I have access to some data? Can I play a little bit with it? And, when you start these simple examples, if you at the same time, for example, are learning Python or something like that, it's also great sort of Python learning, because, just saying, oh, I will learn Python, it's very abstract. But saying, oh, I need to, read in this data table and I want to test to match these, or I want to do that. Great way to gradually build this experience. So, you often sort of, you start from like some small case, you experiment a little bit over time, that's going to be typically in a good organization, that is going to be noticed. People are going to see that, that you're able to do things. And then gradually opportunities will open in that sense. Because, if you then apply somewhere else in the bank and people then know that you did this analysis, you have a great sort of, portfolio that you can show and you can talk from.
Understood. So another question that, I feel we should address and would really appreciate your opinion on this. How have you seen the industry change in the past 2-3 years, with the advent of AI ML methods? We know that in credit risk, there are a variety of ensemble methods. There is a lot of research out there. Well, where do you see this going in the future? And how has this changed the type of skills that were desired 10 years ago for someone starting out versus now? And your take on that?
I mean, really interesting. I think one of the things that's really important to think about when we talk about modeling, because it's easy, if you go on, for example, LinkedIn, it's easy to get a little bit scared because you see very advanced models being showed around, or you go on YouTube and people say, oh, I built this very advanced ML thing, like that. I think one of the things to really think about is, if you build a model that is, there's no thing wrong experimenting, but if you are to build something that is to sit in production, one of the things you need to understand is that it needs to work. And if it doesn't work, you need to very easily understand why it's not working. And I think that's often, if I take, for example, IFRS 9, that you run that every month and you run that through the P&L. And if you run it through the P&L, the CFO is going to be very, very involved. And if you suddenly like, oh, we need to take an extra provision, we need to run more through the P&L. CFO is going to come to you, or one of, CFO that report to the CFO and said, tell me exactly, why are you now wanting us to have more losses? And if you cannot, in a simple way, just disassemble the model and say, look, this has changed, this has changed, this has not changed so much, and you can make a very, very, very simple explanation of it, you're going to have a very hard time. So I think that sets already, I mean, I'm not saying, you cannot build anything advanced, but I'm thinking it's valuable to have this in your back of mind when you think about models, that you need to think about, what type of models is actually possible to build, because they need to work in, everyday production, and they need to work so that it's not too much of a mess to find out what is going on with them. I also think another thing that's really important, often when I sort of, teach internally on sort of when it comes to machine learning methods and so on, I think a good way to understand these methods is if we go back to classical statistics. So in classical statistics, we have parametric statistics and we have non-parametric statistics. Parametric statistics, this is classical. For example, let's say I have a one-dimensional problem, like a one variable problem, and I get some data and I say, oh, it looks like a normal distribution. I have two parameters, I fit these parameters, and I have my distribution. I mean, that's classical parametric statistics. In non-parametric statistics, you might say, oh, this distribution, it's very bimodal or it's very complex. I cannot really have like a direct model here. I will use non-parametric statistics. And in non-parametric statistics, you often make an almost silly model. I mean, in this case, the model might be to say, okay, like the data I have, that, it's 1/n probability to get each of the data points. I mean, obviously, that's not the true model. And if you look, for example, at the tails, I mean, this is going to be a terrible model. But if, let's say that you want to do, for example, resample, you want to say, okay, what is the uncertainty of the mean? But that's probably going to work pretty nice in this resample. I mean, this is sort of a classical bootstrap exercise. But you have to understand the underlying limitation of this sort of non-parametric structure. Now, moving then now into machine learning, a lot of machine learning is effectively, it's effectively non-parametric statistics with just fancier, frameworks. And a lot of it is built around having a very, very large set of parameters, quite similar to if you think about the non-parametrics. I mean, in the non-parametrics, you had one parameter per data point, basically. Here you do something very, very similar, and you need then to understand the limitation of these structures. For example, if you look at the data space, quite commonly, you might have certain places where the data clusters and certain places which is quite data empty. I talked about before that, for example, the tails, if you want to, for example, determine the worst possible outcome, just, straight out empirical distribution is going to be a terrible thing, because then you're just going to say, no, you can never, ever get the data point worse than your highest data point, which is obviously not realistic. I mean, if you're talking about, for example, losses, I mean, you could absolutely imagine that there is a loss larger than the loss that you have observed. So then you need to do something about, the tail behavior. This is what, for example, a parametric model does pretty nice, because it already sort of extrapolate this. But of course, it builds on that it extrapolates in a reasonable way. You really need to be careful about this. If you do machine learning, for example, you need to understand, okay, how is the model going to behave if there is a limited amount of data in a certain place? Could it, for example, be that it then becomes very dependent on exactly what data points you have? Could it have stability issues? So no matter what you do, a good technique I often do is, for example, to do bootstrap resampling. So what I do is I run the model, I take the data set, I run the model. Then what I take is a bootstrap resampling. So I sample from the original data set, but I sample with repetition. So some points are going to be there multiple times, some points not at all, and I run it again. Now, if I get vastly different outcomes, like before it was here, now it's here, okay, yeah, that's not a good sign. I mean, that indicates that the technique I'm operating with might be too sensitive. So that is, again, where I think, when we talk about, sort of machine learning, and I am very much in favor for us being able to think wider than just being restricted by very traditional statistics. And I talked before about this example during COVID. One of the successful things there, why we could get that model to work, was that in our model, we did not have a fixed intercept, but rather the intercept was allowed to change with time. Now, the way we solved that was that we said each point in time has a unique intercept. And then you say, okay, but you're not going to have enough data to work that out. No, but what we did was we said two intercepts close in time need to be heavily correlated. And then we treated that correlation as the parameter. Or as a hyperparameter, and that's basically how we got it to work. And that's a technique called Gaussian processes. And I mean, that is a technique that is an ML technique, but it's an ML technique that's pretty interpretable because you could plot this whole curve and you could look at it. So I'm not saying, don't do machine learning, but my warning is, like, make sure that you understand what you're doing. Make sure that you understand what is it that you are after. I mean, surprisingly often, as I say, I used to sit as a model validator, and people would come to me with very, very elaborate machine learning models, and they would say, and I would say, okay, like, why do you need this? They would say, oh, we need to capture nonlinear behaviors. And I said, interesting. What nonlinear behaviors are you trying to capture? Like, what are they? And surprisingly often, people would not be able to answer that. And I think it's absolutely fine to, for example, say, look, I mean, this problem has essential nonlinearity or an essential correlation that is not being captured. That's great, but know that before you throw yourself into it. So this is also why playing with the data, understanding data, and understanding the problem and the context is really important. Because again, I remember my first example, this I gave about the data analysis and the cab drivers. I mean, he built very, very advanced models. I mean, he's a great guy. I mean, I don't want to be mean to him, incredibly talented. And I mean, he told the story that he also learned a lot that, okay, like, you can make very advanced analytics, and then it just comes that you have basically just reproduced something that was common knowledge, just because you didn't take the time to really collect understanding from the business. So I also think, again, that basically, it's my advice is really, don't say no to machine learning, but don't treat it like the first tool that you bring, like, off the shelf, because it's a very advanced thing, and you really need to know what you're doing when you're dealing with it. I mean, it's a little bit like, if I want to, like, work in my garden, the first thing I do is not I go out and I lease like a bobcat and, like, I start digging everything up. That might be the right tool in certain circumstances, but probably a hedge trimmer might be the first step that you start with. So again, this goes back to this working with maturity, building up your skills, knowing what in the problem really matters, and going from there.
Understood. Yeah, thank you so much. That makes sense. So, we have already taken so much of your time and received such a great insight. I have, one question that might be really beneficial for a lot of people. What is the most rewarding thing about your job? And why would you want more people to have similar jobs? And why should they work in finance industry?
But really, I mean, really good question. I would say that, I think always we work on the quant side. There are sort of two forces that are the essential forces. One is the understanding. Okay, there is a great joy in understanding, and I say, the best, quants, you should be a reverse magician. If you think about what a magician does, the magician, he creates joy out of not understanding. You go to the magic show, you have no idea how he did it, and you feel a joy. The greatest quants are the ones who come and say, look, I've looked into this problem. This is really what's going on. And say, I understand. I understand what is going on. I understand how our business works. And you give people joy by helping them to understand. This is a sort of, a great sort of benchmark to work from. The other part I would say is that, what also is, what is very rewarding is when you feel that what you do really help the business to change. At the end of the day, to be honest, too often banking has a little bit of a bad name because of the scandals in the past, because of greedy people and so on. But banking is a really essential service. I mean, it is the lifeblood of the economy. It allows to give people services that otherwise would not exist. I mean, it connects group, for example, depositors and mortgage holders. These groups could not work together because, I mean, you cannot give people some money and say, go buy a house, but whenever I need the money, you need to be able to sell the house. That would not work. So we enable people to give much more freedom, much more choices than they would really, otherwise have had. And the great joy then is to say, okay, look, as I said before, there are two jobs. Either you make business or you support the business. The great joy is to see, okay, how is what my little contribution here, how is it adding to the overall attempt of us operating as an essential service for the society and for helping sort of, new jobs grow, people fulfill their dreams and so on, and see your place in the overall machinery. I think that's really sort of, what is inspiring when you see it over the long run.
Understood. That's great. So, thank you so much for sparing your time. Any last, last message or anything you would like to share with the audience? I'll also.
Maybe a final thing that I would add is one of the things that I think is underestimated about working in banking. Why I think quant side and banking side is a great sort of career choice if you are sort of interested in numbers, you're a little bit nerdy and so on, is that it is a place that is prepared to actually pay for nerdy skills. I mean, to be honest, yes, there are many of these places out there, but what's good in banking is that it is advanced enough and it's regulated enough that they really need people like us. Like, absolutely, there are many people that are essential banking, but they need a bunch of these nerds to get the machinery working, and it means that they are actually prepared to pay for people like us to operate here. And to me, that is very satisfying. I mean, I think as I mentioned before, one of the frustrating experience when you were in a more academic environment was this constantly having to go around and beg people for money for the work that you wanted to do, and you often felt a disconnect between you would do work and then you would beg for money, and they weren't really connected. I mean, if you got better at your work, it didn't really help on the money part. And I feel what I really have enjoyed is that, like, you sit in your desk and say, okay, I'm here to make things better, and that's going to make the institution better, and that's going to make us a more profitable company, a company that works better, more happy customers, all of these aspects. And that is going to create a long-term good. And that's what my focus should be. I don't have two separate thoughts, both doing my job and then finding money for my job. Money will come if we do great work.
Okay, so more masters and PhDs for banking, always open, right? Yeah. Okay, that's
always open.
That's great to hear. And with this, I come to the end of my questions list. And really thank you for attending this session. Audience who is watching, please leave your comments, questions in the comments, and maybe we can get them answered also with the.
Yeah, and I should say as well, if I'm always open if someone wants to connect on like LinkedIn or similar. That's always happy to get to know more people in the industry. I think we as quants or any aspiring quants, we should really be connecting more with each other and learning from each other. So always happy to connect with people.
That's great. That's great. So this video will be out soon in our community also. So people who are members, you can connect with Jakob as well. Thank you so much for that suggestion, and really appreciate your time. And thanks for thanks to the audience for watching this far, and would really look forward to hearing more questions from you all.
Absolutely. Thank you so much for having me today.